Good afternoon. My name is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for April 19th of 2021. With me today is my colleague and friend, Tom Kemler, who is our Chief Business Appraiser in our Valuation Division. Tom, good to see you.
Good to see you, Eric. Happy Monday.
Happy Monday to you. Well, listen, we'll get right into it. In the markets, last week, markets climbed higher for the fourth consecutive week. We had a series of relatively strong economic data points, and positive performance was really broad-based. I'd say is the stocks gained across various sectors and market cap sizes, and we kicked off the earnings season with banks. We had a lot of banks that reported that released a lot of reserves that they had been building up in anticipation of a credit problem that never really materialized. And so when they released those reserves back into earnings, that helped to bolster their financial performance. But we know that we're going to have a very active this week, as 70% of the S&P 500 companies are set to report over the next 3 weeks in total. But right now, there's a lot of optimism built into the market. We talk about that a little bit in the charts of the week. Analysts right now, with some of the upward revisions that we've seen, expect earnings for the S&P 500 to grow 25%. Of course, we know that March a year ago was very weak with the pandemic, so we knew it was going to be an easy comparison, but we're still seeing fairly strong momentum in earnings expectations. But I know one of the things, and we can talk about this a little bit later after we get into the data here, but one of the things that I know that we're going to be needing to focus on is what management says, their comments on the supply chain issues for the companies that have those types of impacts, as well as potential input price impacts. And I know we want to get into that a little bit, and you have some thoughts from what you're looking at on the economic data side. But last week, the Dow was up 1.2%. S&P 500 was up 1.4%, and the NASDAQ was up 1.1%, and both the S&P 500 and Dow Jones Industrials closed at new highs. If we look at year to date, the S&P is now up about 11.4% after being up about 16.3% a year ago. Dow is also up about 11.5, 11.7. NASDAQ is slightly lower, but still up at just over 9%. And if you look down the road here, Russell 2000 up about 14.5%. And internationally, we've seen relatively strong markets too. And we've seen a dollar that's actually moved higher this year when it was down about 7% a year ago. But those international markets, the MSCI World is up almost 10%, MSCI Europe up about 9%, and even down on the emerging markets, which we've seen a little bit of jockeying in performance, but the emerging markets are up about 4.5% after being up almost 16% a year ago. In the bond market, we certainly talk about that. We had benchmark yields, which fell a little bit. The 10-year Treasury kind of tested about 1.55%, which is actually a 5-week low. So we've clearly seen a little bit of retrenching in the, really despite relatively strong economic news. And for the week, the 10-year Treasury was down about 8 basis points. And we had several catalysts, I think, probably that went into that. One was kind of the temporary cessation of the J&J vaccine. But I'd say that probably has one catalyst, but perhaps not the only catalyst. But I'd say that it probably has as much to do with kind of just basically being in a multi-week pause in rate movements, because we've seen such a profound move in 10-year Treasury rates. In fact, just year to date, we're up almost 70 basis points, or 0.7%, which for the Treasury market and 10-year Treasuries in particular is a really relatively profound move. Let's see, for the year to date, the Barclays Aggregate Index, which is the fixed income index, is down about 2.6% after being up about 7.5% a year ago. And obviously those negative numbers have tempered a little bit with the drop in interest rates this week. But looking across into the commodity markets, oil prices bounced off recent lows, and we continue to see strength in WTI crude, about $63. It's up 30% year to date. And we've got some data kind of confirming an improving demand outlook. And we've got stronger economic data. And, the world's two largest economies and energy consumers, the US and China, are both looking at increasing economic performance. And also inventories were down quite a bit as well. So, Tom, I know you want to get into the economic data. I'll just kind of mention really the couple of headlines here. We're going to talk about retail sales, posted an exceptionally strong number, well ahead of the expectation. We can talk about that. And then we had a consumer price index number, which we knew was going to be high. And we can talk about the base effects of why that number was higher, but it was certainly an evidence of an acceleration from just a month ago. But Tom, you want to talk? I'll hand it off to you. You want to talk about some of the key economic data points?
Yeah, absolutely. I would just say this, that I go to Econo Day, is a nice organizing website for what the major economic releases are for the week. And the way I've been kind of packaging my thinking about it is I really take and pay special attention to those economic reports where not only does the result come in, outside the consensus, but outside the consensus range. And, I realize we're in a disjointed world, but what I've seen particularly this year was that I said, I'm just only going to care about the stuff that's out, not only outside of consensus, but blows away the consensus range. And I thought when I did that I would get a much narrower subset of indicators to talk about. And come to find out, I mean, at least half of them every week the numbers are completely outside of the entire range of what Wall Street's expecting. So
yeah, we've seen a lot of really strong data lately. For sure.
Yeah, so I'm not going to go into all the details, but it just that's an overall statement that the guys it's kind of like weathermen. Those guys are they're getting blown away with these numbers are completely outside of what they're predicting. And month after month they predict either moderation or retrenchment, and we just don't see it. So retail sales, you can look at it a couple of different ways. I mean, the number that was interesting was, it was the headline number was almost 10%, but then even when you cut out vehicles and gas, it was still over 8%, and that was against the consensus. It was about 5%. There's another retail sales number that comes out weekly, and it's from Johnson Redbook. And one of the things that I like about Redbook is, first of all, it's a weekly number. Now you can get lost in the weeds with that, but I had been seeing some really strong numbers on Redbook recently, so strong that I went out and looked at a longitudinal chart of it going back to 2005, and the most recent weeks that have been posted for retail sales are the strongest since 2005. That includes the run up before the great financial crisis. It includes, the recovery from the great financial crisis. And so that these are numbers that we really haven't seen this century.
No, we haven't, and even more recently, we've seen a spike in credit usage, as we've kind of emerged from the pandemic, and we saw a lot of improvement in household balance sheets and a lot of people, increasing their net savings. And obviously there are some dislocations with some of the stimulus payments, but we've really begun to see an interest, almost like a jailbreak of sorts, of consumers really ramping up spending notwithstanding the stimulus, but they're doing it anyway. And you can see credit balances going up as well to
Yeah,
kind of add fuel to that fire, right?
absolutely. And it's, and we're seeing a pull all the way through the economy. I mean, we had issues with inventories, and inventories were running lean for a lot of last year. So
Mhm.
they've been pulling through, and all the way to the manufacturers. I mean, you're seeing something like the Philadelphia Fed, the Philly Fed's manufacturing index was at a 50-year high in March. And they thought, well, geez, that's got to cool down. And it came in basically at another 50-year high in April.
Yeah,
And
yeah.
so,
All the demand figures from the regional Fed surveys. We know the Beige Book, which came out recently, was very positive, despite all of these, supply chain choke points, which we know exist out there. But we see really strong durable goods, and we're actually seeing. Well, I had a chart that I'm not sure if I actually included in the chart back last week, but even apparel, which has really taken it on the chin over the last year, is beginning to perk up. It's still below where it was in terms of kind of weekly store sales momentum, but it's really picking up. And so you get indicators like that, which we know were exceptionally weak last year, and they're picking up. And you dovetail that with all the consumer sentiment numbers that we watch on a monthly basis. And, I always say that it's what the consumer does, not what they say. And sometimes it doesn't always match up, but here lately, it's at least in this data point, it clearly has, right?
yeah, without a doubt, consumers are much more enthusiastic in terms of what they're actually doing than how they're answering any surveys.
Mm.
I will say this though, that we are, and to echo your point, we are starting to see some inflation. And one of the bigger numbers that I saw this past week was the import and export prices, and those are kind of the canary in a coal mine for me. They're what you can get on the margin. And import prices year over year are almost 7%. Export prices year over year are over 9. Now, the one thing that's interesting about that is that the new normal, I guess, for the United States is we're more of a commodity exporter. Especially with the retrenchment in the airplane numbers. So a lot of, you think about the traditional exports for the U.S., it's movies, commodities, guns and defense, and airplanes. And the airplane number, because of COVID, Boeing's just not shipping as much, so that's down. Movies were down because nobody's going into theaters, so there's not really the releases out of Hollywood. The defense numbers, even the new administration has clamped down on some of the defense. So a lot of the real surge in what we're actually exporting is things like oil and the grains, and not the kind of finished goods that you would think of with an economy like ours. So that 9% export price number is picking up all of the oil that we're exporting.
Mm-hmm.
Among
Yeah.
other,
And just
lumber as well.
and I had a chart in our chart pack, to that point. It's a clear spike, in the data as of late, to amplify your point. Yeah. So even, obviously on the consumer side, I know, probably where you're heading with all this is that eventually, you get margin pressure for producers, and to a point where it becomes tough to absorb those, which is for the most part been the case for a long time, for competitive reasons. But at some point, you've got to begin to filter those out into the end consumer. And so, I mean, it's, even though we had a consumer price index that was up 2.6% year over year in the last data point, I mean, the core levels, if you back out the impact of crude, which, we've already said is up 30%, for the year. But if you back out those inputs, it's still lagging, but it's going to be picking up, I feel.
Yeah, without a doubt. And the producer price index was over 4. So that's to your point that the pressure is on companies, and we'll see how long they can hold off and find ways to stave off raising end prices to consumers. But if that kind of disparity is maintained, then sooner or later it's going to flow through.
Right. Well, it'll be interesting to watch when we kind of get past some of these base effect issues, which are causing the CPI numbers to be higher, right? Because last year we actually had a very weak or almost very disinflationary environment, if you will, because of the pandemic. But some people feel like this is going to be more transitory, and then it goes, it mutes itself over a while. I'm frankly of the opinion that we're going to see. Obviously, we'll see the spike in inflation, and it will level off, but it's going to level off, I think, at a level higher than where it's been. I don't know if you would agree with that assessment.
Oh, I absolutely agree with it. Yeah, without a doubt. I think it's here.
Yeah.
And
I agree.
we're starting to pick up the measurement, but a lot of the things that we see are looking back a month or so. No, I think we've got inflation here now. I saw something, and you were talking about the strength of the dollar. It's because, first of all, our real interest rates are higher here than, say, Europe, which
Without a doubt
is a major component of the dollar index. But I forgot where I was going to go with that. I'll toss it back to you, Wally.
Oh, well, that's all right. Well, continuing along this thread of inflation, you learn a lot about the expectations for inflation and for interest rates by reading the bond market, right? And you talk about negative real yields, which have persisted, but it's not a new phenomenon. We've been dealing with negative real yields, for some time, but it just got profoundly negative for a while because of the low interest rate regime before we saw that curve steepening and then the increase in inflation. But, for what it's worth, we've got the 10-year break-even inflation on the Treasury inflation protected securities, or TIPS, of 2.33. So there's clearly the expectations are building in the bond market. And as we all know, we tend to, for a view into what the future is likely to hold, we tend to look more at the bond market than we do at the equity market. But, still, we know that there's a lot of liquidity in the system. I think that to put the bow on this, so we've got a lot of liquidity in the system. Obviously, we've got a lot of consumer interest. We know the consumer has a tremendous amount of dry powder still saved up. So there's purchasing power there. But at the same time, I think we're beginning to see the fact that, almost with their backs against the wall with input costs going up, that producers are perhaps being able to, or will be able to, extract a bit of pricing power in the marketplace going forward. So that's a dynamic that honestly we haven't seen in quite some time. And so we'll just have to see what that looks like, and so frankly see what it does to yields. And I think people are beginning to draw some kind of, I don't know, I think premature conclusions as to, rates have moved up and then now they're paused and they've gone back down. I think they're going to remain volatile, but, the thoughts range from, is inflation, coming, and then, we're going to have more cyclical benefit, economic benefit, or, is it temporary, and, do you buy growth stock? I mean, these are more investment decisions, but, what you read in interest rates and where you think inflation is going, we're at a point now where it's driving a whole lot of speculation, right? I don't know if you have any thoughts on that, but I think we're clearly getting past this whole thought of, well, we've got the virus to deal with, and while it's a threat, I think almost overheating and inflation might be a more prominent issue in the investment world.
Without a doubt. I mean, you have I've have a headline that I saved from a couple of weeks ago. The IMF raised its forecast for the year, said the end of the COVID crisis was increasingly visible, and the IMF raised its estimate of global growth for the entire year from 5.5% to 6%. And what I'll just say about that is that I don't think the IMF is any great prognosticator. And typically, my read of them is that they're a source of doom and gloom, and usually they're overly pessimistic, and they tend to create a yearly estimate at the beginning of the year so that they can cut it and have the headlines that they've cut their estimate. And yet, so it's against that backdrop that I'm seeing them come out and say, things are looking, much better than we expected. And that is, not just for us, that's across the globe. So yeah, I think that definitely pushes things. I would say, as far as interest rates go, a number of two things. One is that you mentioned, we were up quite a bit on a 70 basis points this year on the 10-year. And a long time ago, I learned to look at that 13-week rate of change. And when it really, starts to get 2 standard deviations away from the mean, then you're going to have a retrenchment. And so, we pulled back almost 20 basis points before, coming up a little bit in the last couple of days. So you have that's one reason why I think rates moderated a bit. And the other is that just the calendar, I know that the IRS has officially given an extension, but a lot of people went ahead and did on the normal schedule and paid their taxes. So April's one of those months where the Treasury tends to run a surplus, and so we're not having to have a number of big auctions. And so the headline risk with the huge COVID stimulus and everything else, that's not really gotten untracked yet. And at the same time, so we have some temporary cash flow issues that I think held interest rates down, as well as for the just the overall 13-week rate of change moderation factor.
Yeah. Well, and I think that's an interesting and not often talked about point about treasury seasonal treasury issuance and the timing of cash flows into the treasury and the needs for bonds, because we know that or treasury issuance, because we know earlier this year, I wouldn't say that they're failed auctions by any stretch, but some of the auctions were actually very weak, and just indicating that there was not an appetite for lower interest rates, that there was so much inflation expectation being built in that primary dealers were demanding higher yields on these. So, but I think inflation is going to be the theme that we're going to be watching. It's interesting at a time where we're dealing with this. I mean, we're seeing fairly decent momentum, in the equity markets, again, higher for the 4th consecutive week, broadly speaking. And the other thing I thought was really interesting, just from a market health standpoint, which has really evolved over the last 9 months, I'll call it, is, we have 96% of stocks are trading above their 200-day moving average. So, we have a really strong market breadth that we didn't have last year. And I think that's healthy.
We almost never have anything that high. I mean,
no, we've seen it, just fits and starts. I mean, I'm looking at the chart here, and we saw it, 2011, 2013. That was really the last time it's been this high. But again, you get to, 2010. So coming right off, the year following the great financial crisis, first year recovery and whatnot. But it's high, right? And I think it's good. And then the other interesting thing that that has developed here is that earnings estimates have gone up faster than prices have in the market. And so you've actually seen multiple compression to a small degree from like 23 times forward earnings to, 20 times, which
20,
makes
yeah.
the market less, less expensive relatively. And that coupled with, a lot of, I think a lot of, I'll call it a rise in retail investment, but also a rise in overall sentiment. And then we're going to be riding the wave of this earnings season here too. So it's an interesting dynamic. I think we obviously still have a long way to go on the fixed income side for rates. But we've seen enough of a move that I didn't talk about gold, right? But gold is now down 6% for the year, even though it's maybe picked up just slightly. Yeah, and it was up 24% a year ago. So we're seeing kind of a change in the guard. We still have the cyclical, shift underway, but I think where the market goes from here is where the consensus opinion rides on inflation. Going back to my point that inflation is kind of like the key headline. So maybe in the last few minutes that we have here, I don't know if you would agree with that point or if you have some thoughts on that as well.
No, yeah, I don't want to beat it to death, but I definitely feel like a lot of what I'm looking at is inflationary, and and I feel like that we've seen the end of a 40-year bull market in bonds. What beginning in 1980 and really through 2020. I mean, that's you want to talk about a gigantic secular trend. We rode the second, it was the second oil shock of the 70s after the Shah fell, that created that real double digit inflation that had treasury bonds at 14% at the beginning of 1980, and then we've just steadily for 4 decades rode those down as we crushed inflation out of the system. And I believe that's over. And for a number of reasons, but if for no other reason than just the massive issuance that we're going to see, from the Treasury as these spending bills actually get traction. The COVID relief thing, I think that they've actually only about 20% of that has gone out the door already. That was mostly the checks. Everything else went into budgets somewhere, and so that's going to be a steady stream of stimulus for probably a year, and then you're going to have this infrastructure thing on top of that. And all of this is on top of a really hot economy that's about ready to have everybody, just literally rip off the mask and get after it.
Absolutely. No, I couldn't agree with you more. Obviously we're dealing with a political dynamic that's a little bit unique right now because you almost have 4 different parties, right? And you've got, a tussle, on the far left and the far right, and Biden is trying to placate, but it's hard. And so there's going to be a lot of debate, about this follow-on infrastructure bill and what that looks like. But as you said, and I agree with you, that there's a trickling effect to all the stimulus that's been passed and but not yet implemented. So I think it just provides more feedstock. And I think it gives you comfort in, the consumer spending numbers, obviously sentiment numbers that people are still getting checks. You've got an improving economy. We didn't mention the labor number, and we're kind of up against our wall here, but, jobless claims tumbled to 576,000. So, you're seeing evolution on all these things. So it's almost like, almost like a Pollyanna type scenario that rates are moving higher for the right reasons. Inflation is kind of normalizing to some degree, but the equity markets are still going up, and we're experiencing reasonable growth. So that's just kind of the backdrop right now. But so that's basically all I've got for this week. Tom, you have any closing thoughts before we move on and let people get to their week?
Well, I just had the one geopolitical note, about the shadow war that's been going on between Israel and Iran. We've been, the Biden administration has been very vocal about wanting to go back to the Iran deal. And I think that Israel is doing pretty much everything they can to create conditions where that's going to be impossible. And so they've had, now 2 attacks on their main, um, the centrifuges that enrich uranium. And they had, a pretty amazing attack when you see the Iranians came out and said, referenced the Israelis and said the design of the enemy's attack was very beautiful. So it was definitely an overt compliment, but it's been estimated that 2/3 of their centrifuge capability was ruined, and so I'm concerned about that because the pace of events there seems to be like almost every other day there's something happening that's pretty big, like a ship is blowing up or being mined, and that's got implications for oil prices, as well as just outright hostilities. At some point, it might not be contained, and so that's a real. With COVID, I don't think we're covering geopolitical stuff as much as maybe we should. But that seems to me to be like a lit fuse, that if we're looking for reasons to not be as Pollyanna-ish about everything looks great, I think that's the situation with Israel and Iran right now is really one that a lot of headline risk there.
Very fair point. Very fair point. Geopolitical risk is something that we can never. It always exists in the, in the range of risks, I guess, that you put on the market, and relatively seldom do we actually invoke it. But in this case, I think I would certainly agree with you that that's something that we need to keep our eye on. But anyway, appreciate that closing comment. So we will end it there. On behalf of all of our colleagues here at BKA Wealth Consulting, I hope you have a safe week, a wonderful week, productive week, and we'll see you again soon. Take care.
Bye.